Hello and welcome again. This is Robert Schein, Managing Director, Partner of Blanke Schein Wealth Management. Thank you for joining us for our February 27th, Tuesday edition of Market Insights and Observations. We're talking about the three topics that we believe are really important for you to pay attention to because markets are as well. So let's get right to it, and thanks for watching. Our three topics of today are what markets are watching, what the Federal Reserve is watching, a lot of historical data, and we'll go through real-time data as well as the economy is apparently heating up once again. And so that could be an issue for the Federal Reserve. We're talking about inflation waves, historically speaking. We'll look at it and where we are relative to today. Rising prices, as well as the rate cut probabilities moving forward. So let's get right to it. What you're seeing here is a chart of the S&P 500 in red. So it's the red line. And this is a chart of the 1970s, so 1968 to 1980, if you will. And behind it, and these blue sort of waves here, let me see if I can get this for us here. These blue waves, we have what's called the CPI year-over-year data. So you have sort of this data set of years of just inflation waves. And as I said before, and we went back, when I was in New York, a few weeks right before Christmas, on that media tour, I consistently had the prevailing theme that the Federal Reserve in 2024 is going to have to maintain a higher for longer mantra. And that's exactly what's playing out as we're in 2024. As soon as we started the new year, there was an expectation of rate cuts to be up to 6 rate cuts. So 2 to 3%, if you will, depending upon who you listen to from an expert standpoint. The reason why we were in the camp of, and we still are, is that the economy is strong. Employment is strong. The CPI data is strong, and it's only accelerating because we actually have a strong economy. Now, there's a dichotomy of a bifurcation of the have and have-nots. That's another conversation. But for those who have assets, investments, real estate, that's the number one liquidator or the key to stay ahead of debt over time. So when you have an inflationary environment, you want to have assets, anything from baseball cards to gold and everything else in between, simply because those assets, we even saw Bitcoin making a surge this morning. And all markets are different at different times. But if you own assets, again, real assets, they will stay ahead of inflation. However, there are some times where those asset prices do get scared simply because of inflation waves. Inflation comes in 2 waves, historically speaking, over the last 5 inflation waves over the last 50 plus years. 87% of the time, there's 2 waves. So we're on the downward trajectory slope right here. This is where we are of the second wave. Now, the concern for the Federal Reserve, for everyone, should be, will we re-accelerate back in the 70s as we did on the inflation side? If so, then the S&P 500, which is seeing all-time highs, why? Because of strong earnings, because of a strong economy, because of a consumer that still seems to be hanging in there, irrespective of high credit card debts, which is sort of puzzling at this moment. The question is, this is the top 50, the Nifty 50, back in the 1970s, and they were the leaders of the S&P 500. So you take S&P 500, you take the top 10%, the top 50 companies, and those guys were just the go-go, those companies that you wanted to own at that moment in time. It's kind of like what you're seeing with the Magnificent Seven in today's market. That being said, the Nifty 50 was the place to be, and so we also saw this concern. The market then pulled back on that second wave of inflation re-accelerating. Now, what do we pay attention to, Rob, to make certain that, hey, listen, are we re-accelerating? Well, there are some sort of surveys. This is a survey, the NFIB survey, that shows companies are looking to raise prices. So this is a survey of over 10,000 small businesses, and it goes out monthly, and it talks about, listen, a range of items that are questioned, and one of the biggest sort of teases out or drawn out from this is the small business owners are looking and planning to raise prices moving forward. And they either see strong customer demand, they're either hitting their stride in their niche, or it's strong economy that's giving them confidence. Again, if you're a small business owner, you have to stay ahead of the inflationary pressures, wages and goods, obviously the services that are components that are in, as you're managing your business. So as those pressures rise, you have to pass that on if you have price elasticity, depending upon what company you're in. And if you're in the travel industry, a lot of those are doing just that, as we're seeing travel still keep up way ahead of inflation if you've looked at any airlines lately. But this is the third slide we're going to talk about, and it's exactly what I discussed when we first started the conversation today, which was the Federal Reserve's expectations, the market's expectations of what the Federal Reserve is going to do. March 20th is the next Fed funds meeting. There's zero expectations now. I think it's about a 4% that they're going to lower interest rates on that, and then we skip April, go to May, and there's sort of a higher probability at that point in time. Again, there was a 94% probability that in March, starting this year, we would see the Fed cut by 25 basis points. That's clearly not going to happen. What you're just seeing here are all the iterations of every time they update sort of their quant analysis of the Fed funds futures. And essentially, all you really have to pay attention to is these are the expectations starting on the on this axis here of a rate cut, and the probability is just going down, down, down. Again, strong economy, and the earnings are supporting just that. So we're going to have to pay attention. What happens? The market is in a momentum mode because we see everything's moving forward in a positive basis. But will the consumer get hit by higher interest rates? We're positioning our portfolios to be cautious moving forward. We've had some great movement year to date. We've had a great 2023. But we also want to be proactive in how we position our portfolios, and it's not a bad time to rebalance. We're also putting a lot of bank cash to work. Clients are still bringing in cash with CDs coming due. So we're happy to make that happen because we are seeing some very attractive rates in the fixed income markets. Again, if you want to share this, please like and subscribe, share this with friends and family. If you want a personal one-on-one update review, reach out to us at Blanke Schein Wealth Management. We're happy to hear about your personal situation, or if you're an existing client, let's get a current update on your current situation in life, your goals, your feelings, and we'll move on as well as see where you are. Sounds good. Thanks for watching, and we'll see you again next time.